So what is EBITDA, and is it important to know about when you are buying a business? Absolutely, yes, it is. And we see a lot of people here at Franchise City buying business or investing in businesses with no idea of these very basic financial terms and how important they are and what they mean. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's one metric to determine financial performance of a company. And EBITDA is the company's earnings with those variable expenses, so interest, taxes, depreciation, and amortization, backed out. So those are taken out of the equation. So why is that important to look at? Well, one reason that you want to look at EBITDA is it eliminates the variables such as financing and capital expenditures. So for example, the present owner, they've got a substantial loan on the business. And if you only look at net profit, of course, the loan payout is taken out of that. You're not going to have an accurate representation of what your profits might be. If you're buying the business, you have no financing, more financing, or less financing. Now, if you do financing, your terms and your amounts is going to very likely be different than the other owner as well. So if you're comparing companies also from an investing perspective in the stock market, EBITDA, it allows you to compare companies on a more level playing field with those variables of loan interest, depreciation, and amortization backed out. Now, that said, EBITDA does make it much easier for companies, and particularly tech companies, to look a lot better on paper than they actually are in real life. And actually, the SEC does not even consider EBITDA as a generally accepted accounting principle. So be sure to understand the limitations of EBITDA before making any decisions. Now, EBITDA is often confused with net income. That's quite different. Net income actually calculates the total earnings of the company after paying the taxes, depreciation, and amortization. So then some people will argue, I just need to look at net profit. It's the best figure to look at if you're buying a business. Absolutely not true, but most inexperienced buyers think all you have to do is look at net profit. Not necessarily. It is an important number, but not necessarily the end of the story. With a small business, and I'll give you an example here, company might have a very small net profit. We'll say $6,000 a year, this business, whatever it is, bakery, pizza shop, whatever. And based on that small net profit, you as a buyer, you probably look at that $6,000 and say, I'm not buying this business. It's only making $6,000. Most buyers, in fact, would not think most inexperienced buyers would think that's not a good business to buy. But when we dig deeper and we look at discretionary earnings, it's another important number. We see that the owner took a salary of $100,000 a year, right? So that money went into the owner's pocket. But remember, owner's salary is actually an expense for the business. Same as all the other employee salaries, the owner paying themselves, that's an expense to the business. Now, they may also have paid for fuel using company money for themselves or for family members for business trips or whatever else. They may have made charitable donations that you're not going to be making. All of these things are included in direct discretionary income and have a direct impact on the financial benefit, but it does not show up in net profit. Another thing you have to consider is there might be one-time non-recurring expenses that will skew the net profit in any given year. So for example, bakery or pizza shop, they had to replace a very expensive oven after 10 years. That's likely not an expense that you have to worry about in the near future. So in this case, a business that did not show very well at $6,000 profit, when we look at the discretionary earnings, we see the actual owner benefit was $100,000 a year. Salary, fuel, trips, and an expensive oven on top of that, that's almost $150,000 a year that's going directly into the owner's pocket. So net profit, not always the end of the story. Now, conversely, sometimes the business might show a higher net profit, very impressive net profit, but no salary was taken by the owner, as is often the case, particularly in startup businesses, or if for example, repairs or replacement of those equipments, the stoves, the ovens, whatever, they might be needed in the near future, right? So that net profit, while it's high right now, owner's not taking a salary and the ovens need replacing, that's going to be particularly difficult for you when you first buy this business. You got to make sure that you have padding and you've prepared for that. If you need help finding or researching a franchise, give Franchise City Broker Group a call. Link is above. And are ATM machines a good business? I'll put that link down below. Thanks for watching.